So it was shock and awe from Frankfurt after all. As you probably know by now, the much anticipated sovereign QE bond purchases from the European Central Bank went rather further than they had briefed the market in advance. The purchases will be of 60 billion euros per month, not 50 billion as thought, and they will essentially be indefinite. They will carry on until inflation is moving clearly towards its target of almost 2%, as inflation is currently below zero, and as those terms have been defined very vaguely, they plainly have the ability to keep doing this for a very long time until they are convinced that deflationary psychology has been squeezed out of the market. Now, the most important implication, plainly, has to be for the currency. The ECB needs the euro to be weaker, and if we take a look at the euro on a trade-weighted basis, you can see that it is indeed very much weaker than it has been. In fact, against the dollar, against which it fell more than 2.3%, it had its fifth worst percentage fall for a day ever. So plainly, this has had a result. Also, as you can see, there is a lot further, judging by the historical evidence, that the euro could fall, given that we have an indefinite commitment to keep yields at the floor, giving almost no reason to keep money parked in euros. It's safe to assume, as many in the markets are now assuming, that the euro weakness could intensify from here. Now that has an implication for other assets. The S&P 500 here in New York had a very good day today. It's now back to being in positive territory for the year, which is not surprising if another central bank is more or less bribing people to move their assets out towards the US. Now let's take a look at a very interesting new development, which appears to be the return of the carry trade. What we're looking at here is the exchange rate of the Brazilian real, which pays a very high interest rate against the euro. You can see a dramatic appreciation over the last month or so. This looks like it's the return of the carry trade, where you borrow in a low-yielding currency and park the money in a high-yielding currency. It used to be done with the Japanese yen, and it works beautifully unless the funding currency suddenly appreciates on you. Plainly, a lot of people in the forex market are now putting money into those high-yielding currencies. That could have significance. It could create a return to the notion of currency wars, where countries like Brazil complain that their currencies have become overvalued. Also note that even though the great fear at the moment is of deflation, gold has also recovering. It's got above $1,300 per ounce today for the first time since last August. When central banks do things like this, the instant Pavlovian response is to buy gold, even in the midst of a deflationary scare. Again, there is good reason to assume that rally in gold could continue. For the longer term, this is plainly a move that will help risk assets, that will help assets outside the Eurozone, and that will boost any asset that pays a yield. We have experience with what QE does to our asset markets. It's a very safe bet that that's going to happen. What would change it would be shock and awe from the economy, an unexpected negative event, possibly from the Greek election, more plausibly from those two economies that matter most, China or the US. For now, it's a bad idea to bet against central banks and QE. It's best to assume that the rally in risk assets can continue.